Bear markets can make or lose you a fortune. And in today's video, we're going to talk about how to best approach a bear market based on your personal trading style and risk tolerance. Let's jump into it. Welcome back to the channel, guys. If you enjoy my videos, make sure to hit the thumbs up button as we get started. We're talking about a popular topic, especially at the time of recording this video, where we have seen the stock market sell off pretty tremendously. But in this video, I'm going to be talking about how traders can actually potentially benefit from a bear market or a market in which everything seems to be selling off a cliff. We'll be discussing indices, but we'll also talk about other markets as well, like currencies and commodities, and how best to approach these sorts of things in a market that can't seem to find a bottom. Now, before we go any further, we need to establish what our risk tolerance is personally when it comes to markets in general. There are three options that I'm going to be discussing here with you guys today in terms of how to best take advantage potentially of a bear market. A high risk, high reward option, medium risk, medium reward, and low risk, low reward approach. Now, again, if you're somebody who really prefers to stay, safe and you're not super interested in seeing big account swings, you may want to skip ahead to the low risk, low reward. But today we're going to be starting with the high risk, high reward approach. And let's just model this out for a second. Let's just say that you have a very bearish perspective, whether it be from a technical analysis, fundamental analysis, sentiment analysis, whatever your reasoning is. I personally look at fundamental analysis and sentiment analysis pretty heavily to make a decision as to whether I'm bullish or bearish on the markets directionally. But let's just say you have your own style. Let's assume you have a strategy and approach. And let's say that you are very bearish. You think there's a very good chance that markets can continue to move lower. And let's say that you're also comfortable with taking a higher risk approach to the markets, and you don't mind seeing bigger swings to potentially benefit from bigger rewards. Now, there is, when I say this, high risk, but also very high rewards. Bears can make a ton of money really fast when it comes to sell-offs. As you'll notice here, when we just zoom out, take a look at this recent sell-off that we're experiencing in the S&P 500, and you can actually see that in a few short weeks, we've wiped out over a year's worth of gains in the financial markets. That is incredible, and that is why bears, when correct, can make a tremendous amount of money very quickly. But again, there is high risk and high reward with this approach. The first approach to making money in a very bearish environment is aggressively shorting indices. Now, again, I say this is high risk, high reward because indices can violently bounce back, and we'll discuss that in just a moment. In fact, we're seeing that here on the day that I'm recording this, a violent bounce back. But let's talk a little bit about how best, in my opinion, if you were to be bearish and you have a high risk, high reward approach, what's the best way to short indices? Well, I'll jump right into it. So first and foremost, I am not a fan when it comes to indices of trying to call the top, right? So in a market that's grinding higher, this is probably not going to be a very good approach in my personal view. Shorting indices when they just seem to be going up every single day is really not the catalyst that I'm looking for. In fact, what I'm actually looking for if I'm going to get bearish on an index is actually looking for key levels of support like we have marked on this chart to break, but not just break, decisively break and continue to break key levels of support. What you'll notice about this recent sell-off that we're looking at in the S&P 500 is that you actually have consistently levels of support failing to hold by buyers. A key level of support here and here, both of these led to major sell-offs in the market. Now, again, how do we approach this? Because it seems like this thing waterfalls down and there wasn't really much of a chance to get involved on the short side. Now, there's different ways of thinking. Some people are more aggressive and they get down to the intraday level. Let's say you can get into the 1 hour chart and look for minor retracements. If you're truly very bearish and believe you have a good reasoning to be bearish, these minor pullbacks could be traded on an intraday basis the same way I'm about to discuss on the daily chart. In fact, this would just involve basically highlighting key levels of structure like I just discussed and recognize that when those levels fail to hold, rebound moves are short selling opportunities. We can see that actually repeated multiple times, and bears have had a remarkable opportunity to sell into all of these rallies as the market continued to get pummeled lower. It's almost like once the market gets into sell mode, there's very brief minor pullbacks before selling continues. But back to the daily chart, I want to discuss more of a actual bearish perspective on a higher time frame, not just I'm just taking it lower for the day. And now, of course, intraday traders can do exactly what I just discussed, highlight on the lower time frames, key levels of structure, and trade the waterfall down on retests of key structure, waiting for those pullbacks in order to get in with a better risk reward. But I want to talk also about the daily chart. And this is where if you are very bearish on something and it really does have follow through to the downside, like we're really entering into a bear market, this is typically what you see. You typically see bounce backs that are quite violent on the upside. In fact, in history, bear market rallies where the market actually bounces are some of the most aggressive and violent bounces that we have actually seen in market history. That being said, there's a key indicator that I think we need to consult in order to know that the risk to reward profile for the market looks very attractive. Let me show you the put to call ratio, which is a key guiding factor when it comes to potential short setups in a bearish market. Before I show you the put to call ratio, notice that around this time, let's get our dates right. This is about March 13th to March 25th. That period of time is what we're going to look at on the put to call indicator to see what market sentiment was. I can tell you that market was very bearish already at this time, but as we had one of those violent bounce backs, it faked out many of the bears and the bulls. Bulls started to get very bullish, right? Bears gave up the fight a little bit, and this presented an entry opportunity that had a very attractive risk to reward and was retesting the 38.2% retracement. So from a technical basis, before looking at the put to call, what we saw here was a proper bounce from the lows to at least the 38.2% retracement zone, which also happened to line up very nicely with a key level of resistance looking left. So that's the technicals, but let me show you this powerful indicator. The put to call ratio allows us to view the options market activity. And even if you're not an options trader, this is a very powerful resource for understanding best what the crowd sentiment is looking like. So remember I mentioned those date ranges, right? The middle of March, we saw the put to call ratio get very high around March 13th. Let me show you where March 13th lined up on the chart. And coincidentally, March 13th was actually the short-term low for this market before we saw a very sharp bounce back to the upside. The reason I'm bringing that up is that, again, we would want to avoid chasing the sell side move when the put to call ratio is very high. The reasoning for that is because this is telling you that many people are out there buying puts. And what this indicator, the put to call ratio, is showing you is simply the volume of puts being traded versus the volume of calls being traded on the options market. If you're unfamiliar with options at all, totally fine. The puts are basically bearish bets. Calls are bullish bets on the financial markets. And so when we take a look at this, we can see a huge amounts of puts occurred right towards those lows. So we wouldn't want to be chasing when everybody else is already bearish. However, take a look at where the put to call ratio actually began to normalize around the March 18th through the March 24 period. Let's go back to the charts, and what we can see here is around March 18th to March 24th, that was right around this area. So combining our put to call analysis showing that bulls and bears had normalized and moderated a little bit, basically that's telling us sentiment normalized a bit. The risk to reward profile becomes a bit more attractive if we are going to hold tight to our bearish analysis and stay true to it. Again, when everybody is bearish on something, the price of puts gets very expensive. Making bearish bets is basically chasing the market. Whereas when we waited for the put to call ratio to normalize and give us that confirmation that market sentiment had normalized a bit, the risk to reward profile became much more attractive to this market. And this produced a very nice short selling opportunity around the 38.2% retracement after, of course, the put to call ratio had normalized. This is a very important indicator for this very reason because it allows us to track when sentiment is becoming most extreme or most normal, or even in the other extreme, most euphoric, right? So we call this the put to call ratio. We have our levels here showing extreme levels of fear, extreme levels of greed, and a neutral sentiment. So essentially, if you're bearish in a market that is going down, that's totally fine, but just be careful, in my personal view, that you're not chasing something that's already gone too far lower and maybe overbought or oversold and due for a retracement. By the way, the put to call ratio, this tool that you're seeing, can be found on our website, a1trading.com/edgefinder, which is our market scanning software that helps traders spot opportunities and build a more conclusive, insightful look at the financial markets. We have several market sentiment tools, which can be very useful in the environment where we're at, where we're seeing these extreme sell-offs and there's opportunities out there, but without the proper tools, you may miss those ideas. So if you'd like to check out the Edge Finder, get some more information, head over to our website, a1trading.com/edgefinder, or chat with us directly using the first link in the description to speak with our support team about this tool if you have any questions. So of course, the next question is, how do you know when to get in and when to get out? And for me, this is going to be a combination of what I just discussed, looking for sentiment readings to normalize, but also looking for key technical levels of support that could now act as resistance. Very simple technical analysis stuff. And this idea, basically a retracement up into the 38.2 to 50% retracement, plus a key level of resistance that we notice by looking left, and that put to call ratio, all kind of concluded this may be a good risk to reward sell setup. My personal approach, and this is where exit strategies can come into place, and there are many different ways to exit the market. In a bear market, here is my personal opinion about how best to approach this. On an overall basis, I want to give my stop loss a little room, but I really don't want to give this thing a ton of room to the upside, because I want to be right quickly and I want to take profits relatively quickly when it comes to shorting an index specifically. The reason for this is that indices typically grind slowly up and rapidly fall down. So if we're going to be bearish and making money on the downside, we want to be correct quickly, or we want to get out of there to avoid this sort of environment happening to us, right? We don't want to be short in a market that is grinding higher for weeks on end. We want to be correct quickly or get out of there. So for me personally, the way I would approach this would be, of course, doesn't look super genius, but I would actually be looking to just take this move back down to the previous lows, essentially just playing that retracement lower and then taking my profits and moving on. Now, there are different styles. Some people may use trailing stops. Other people may use partial take profits, meaning maybe they take some here and then they leave a runner or leave two runners and take profits further down the move. Exit styles are a very complicated topic that I think more traders should spend more time doing. In fact, I've done a video on this and I'll leave it linked in the top right hand of the screen right now if you'd like to track some more exit styles that might be suitable for you to explore, backtest, and try out for yourself. And just a bonus mention for this high risk, high reward approach, for currency traders out there, Forex can also be a way to diversify what you're looking at, in the sense that you're not just trading indices or stocks, maybe you're also looking at currencies. For example, the Australian dollar has gotten absolutely hit very hard here recently because it is a commodity-centric economy, and with economic recession or concerns that are coming in, we do want to be aware that currencies that are very built around their economies being commodity centric and cyclical based economies that perform well when the whole world is demanding lots of raw materials, oil, copper, iron ore, these things, they can get hit very hard. So you can actually look for potentially short side opportunities, not just in indices, but in currencies that may lose value in a bear market. The alternative too would be to look to buy into currencies that are stronger in a period of decline and global concern. For example, the Japanese yen has actually been strengthening against the US dollar. Hence the reason this chart is going down, right? People are buying into the Japanese yen for safety, as the Japanese economy is perceived as a pretty stable, low risk, low reward, and very low interest rate economy that people essentially borrow during times of good times, or they buy back into the Japanese yen during times of fear. Another notable currency that has a similar trait is the Swiss franc, and is also definitely worth considering in terms of if you have a bearish perspective on general market outlook, you may look to get long the Swiss franc. Now, a specifically tailored currency pair to this idea would be, for example, the Australian dollar versus the Japanese yen, which you can see has been in a pretty sustained downward trend amidst everything that's going on at the time of recording this video, where there is global recession concerns, tariff worries, trade war stuff, and markets are very nervous, right? So people are actually selling the Australian dollar, perceived as that more risk-on, higher risk currency, and then going into the defensive one, the Japanese yen. Another very popular pair for this is the pound against the yen as well. The next item on our list is a medium risk, medium reward style of approaching a bear market. Now, we just talked about straight up shorting the indices, and I have to disclaim something. I personally don't really like to short indices, as it's not exactly a good fit with my traditional trading style of trailing stops in my personal experience, and just not something that I love to do and have had a lot of success with. I don't really care to short indices. The good news for people like me, and if you are similar to me who don't like to short indices aggressively, is that there are other ways to approach this. One of the reasons, by the way, that I don't love shorting indices is because bear market rallies can be so aggressive, so violent, and so sudden that if you are not very tight with your risk management, you can get in a lot of trouble very quickly. For example, this bounce back right here, by the way, that's an 8% move in 2 days. That's huge. Just like in a bear market, we can have these down days that are massive. You can have bull market days or bear market rallies, rather, that can completely wipe you out very quickly. So getting into the medium risk, medium reward approach, how can we still potentially benefit or at least keep ourselves safe in a bear market without going super aggressive to the downside? So if you're someone like me who has a stock portfolio, I do trade on a shorter term basis and I'm a swing trader, but I also have longer term positioning as well. If you're someone like me, there is a mixed approach that you can actually do to what I'm discussing, which is essentially looking for good companies and opportunities to the long side, but also recognizing that we could add some short exposure to hedge our bets a bit in the portfolio. So for example, let's say in your portfolio, you have some shares of Apple or Microsoft or whatever, and you also want to pick up some potential hedges in the market. This could include basically buying some puts to protect your portfolio from further downside. That is an option that you may choose, quite literally an option that you might choose to choose. Or alternatively, you could simply pick up some short exposure, or you could sell parts of your positions if you simply want to lower your exposure to market downside. There are many different ways to play defense in a bear market without straight up playing aggressive offense, right? So I would say if you're shorting the market aggressively, that is playing offense in a bear market. And if you are closing out some of your positioning to reduce your exposure to market downside, I would say that's more along the lines of playing defense. And personally, I go the defense route when it comes to bear markets. In bear markets, I am far less concerned about making a lot of money than I am simply about protecting my capital and playing defense in my portfolio. But there are different types of traders out there. Some traders make a majority of their money in bear markets going on offense. For me, it's not really my style, and I prefer to go some of the defensive routes. So how can we do that? Well, on the defense, right? Medium risk, medium reward. You could potentially pick up some short exposure. You could play puts to the downside with a small size. So let's say that you do take a short position on that level that we just got previously done discussing. We look for resistance levels that potentially could hold, and we trade the downside, still holding on to some of our long-term or bullish exposure in the markets. The other way to play medium risk, medium reward is potentially take advantage of the downside, but to slowly start to accumulate long positions in stocks that you like, individual names, over the long term. This is a dollar cost averaging approach and something that I personally do when markets are 10% or greater to the downside. I typically am slowly accumulating new stock positions or adding new stocks to my portfolio for the longer term. But for short-term traders, how could we take advantage of this? Well, the other medium risk, medium reward approach, which may not be suitable to everyone, and if you're not an options trader, might not be the most suitable, is actually selling volatility. This is something that, again, does carry some risk because volatility can be often hard to predict exactly, but volatility in the form of selling puts or selling calls or selling iron condors. These are things that might be suitable for some traders and investors out there that have a medium risk, medium reward tolerance, who want to take advantage of elevated premiums on options and are comfortable selling options to other traders. If you're not familiar with this, it's essentially trying to play the market maker, and I have some videos on this. I'll leave them linked in the description, and in the top right hand of the screen, I'll show you one of my favorite options trading strategies. Another quick medium risk, medium reward approach is to simply stay cash heavy. And what I mean by that is to reduce your exposure, but also at the same time, keep that exposure ready to deploy at certain key levels. So I talked about dollar cost averaging. For me personally, I have recently started to long-term accumulate some shares of stocks that I like, because my way of playing defense has been, when we've broken key levels of structure, I've maintained a good cash position in my portfolio. Now, this is of course a stock portfolio, so there's cash in the account. If you're trading on a CFD brokerage, or if you are trading on a Forex brokerage, whatever, the equivalent to this would essentially just be having very light position sizing and margin available in the account for possible trading opportunities that you see coming, whether it be short, medium, or long term. But for me, in a cash portfolio for stocks, I'm just saying I basically have cash available and at the ready, patiently waiting for longer term opportunities where I see stocks on sale. The final topic will be low risk, low reward strategies for people who don't love what they're seeing in markets. And this is stressful and traumatic. I've said this recently on my channel quite a bit, and I'll say it again. You're not crazy for feeling the way you're feeling if you see a market like this and it has you all sorts of stressed out. You're not crazy. The market's crazy. And what can we do in those sorts of environments for those of us who are not so interested in playing offense, or really are just mostly interested in playing defense? They just want to avoid taking significant losses and aren't so worried about capturing tons of upside in a market continuation to the downside or a steep reversal. This would be your low risk, low reward type people. And in this environment, there's a couple alternative options that you could play. What you can do in this case is you can diversify, right? So basically you could spread your bets across many different sectors. You can different stocks. You can also trade. You can move into other markets, perhaps get into currency trading, or you can look to trade commodities. Maybe you're focused on gold, something that I'm personally doing. I would not call this low risk, low reward, to be fair, but in small position sizing on a stock portfolio, you can buy very little amounts of gold through the ETF GLD, for example. And if you're looking to start a stock brokerage account, I'll just make a quick mention to the one that I use. It's called Webull, and it'll be linked in the description below. So in a stock market sell-off like this, one of the big low risk, low reward approaches that traders can utilize is what I was discussing earlier, which is essentially you're not short, but you're holding cash, and to wait more patiently before getting involved, right? Now, there is a big risk here in a different way. It's not risk of capital loss, but it's risk of missing out. And what I mean by that, there's no such thing as low risk, high reward when it comes to trading. And so if you're going to sit in a cash position and you're going to say, well, I'm going to wait until this thing potentially goes much lower, that is low risk in the sense that your capital, if you are not in the markets, may not get hurt further. But what if the market bottoms out and starts to get back to the highs? You've missed out. And although that doesn't cost you money in the form of, direct losses, it also does mean that you would be missing out on gains. So low risk, low reward is a bit deceiving, and it does come with low reward for a reason, right? The risk is basically you can't capture much of the upside. So in my personal approach, when it comes to, a bear market, I kind of lean towards medium to low risk reward. What I mean by that is that I'm not looking to aggressively trade short side on the market, but I'm also keeping cash in the portfolio, but also deploying it regularly into long-term stocks that I like, and not too worried about catching the bottom, because catching the bottom is very difficult, and oftentimes the bottom is so briefly there, like we'll just see one of these, and then it's like the bottom was only the bottom for like a total of 5 minutes, right? That's how bear markets typically end, is they they crescendo into the bottom, and then they bottom out and nobody believes them. Let's talk briefly about a bonus topic on this, which is trading the rebound. What do you look for when it comes to a market bottom? This is what I personally look for. I look for signs that we've had a capitulation low, and that put to call ratio that I discussed earlier right now is actually showing you a good example of this. When the put to call ratio gets extremely bearish, right? Fear is very, very high out there. I take that as a signal to start looking for contrarian opportunities. Specifically, what I'm looking for would be the market to bounce sharply after a capitulation sell-off, like one day where just fear reaches an extreme. And I would say that that really occurred around here. Now, of course, the market could go lower. I could be wrong about this. But the part two to what I just said is looking for technicals to solidify that idea. So specifically, I'd be looking for something like this. Basically, key levels of resistance to now start acting as support, reversing the topic that we discussed at the opening of this video, where we had key levels of structure being broken to the downside and respected by the sellers. We're looking for the opposite when it comes to catching the rebound. So for me personally, I don't try to time the bottom perfectly. I like to dollar cost average. And when it comes to a short-term trading opportunity, I am looking for those capitulation sell-offs, that extreme bearish sentiment to start to kind of cave. And then I'm looking to actually look into buying higher lows and try and ride the trend back up. So that is personally how I like to approach bear markets. If this video was helpful to you, do me a big favor, hit the thumbs up button, subscribe if you want more content like this, and we'll see you in the next one. Many traders don't know this, but a lot of trading profitability is dependent on you using the correct brokerage when you're trading. Remember that your trading costs are an input to your trading results. So what I mean by that is trading costs such as commissions and spreads and swaps and overnight holding things. All of that plays into your final results as a trader. And another huge thing that I cannot emphasize enough is you making a deposit into a brokerage account can earn you some significant trading perks if you use the right offer links. In the description down below, we have put together a collection of some of our partnered brokers that offer welcome bonuses when you make a deposit, free stock shares when you sign up, and access to some of our products for free. On our website, a1trading.com/brokers, that's a1trading.com/brokers, you'll see a list of free offers that you as a client to these brokers can get upon sign up and deposit. Do not make the rookie mistake of just signing up for any brokerage and not using a specific offer link. If you use our referral links, you'll get something out of it, and you'll also be supporting our work here on this YouTube channel. Thank you for watching. We'll see you next time.